From one retail investor to another, this is Trader72. Welcome back, guys, for my second upload this week. We've obviously got the results tonight from Netflix, so we'll be coming to that, and hopefully we'll be straight on the back end of that. We'll be uploading results. But in the meantime, let's get straight to it. I have bought more shares in my Adobe. Yes, Adobe, which is my biggest holding in my portfolio currently. I decided to strategically move in as the share price is slightly on the uptick at the moment. Now, this is why I think Wall Street is wrong. I'm going to give you some facts about why I feel this. Bear in mind, guys, that Adobe is part of my industry and my other main job. 30 years in the film industry. I have obviously not directly worked with Adobe, but I know a lot of friends that I have done through editors, creative professionals within the film industry, commercials and broadcast. So obviously, I have quite a strong, in touch with that stock as it is. And I feel that the stock has been battered for the past year or so by Wall Street, and for various different reasons that obviously I'm sure some of you may well be aware of. But as you can see there, we're going to go into delve a little bit more into Adobe and why I bought more shots. Obviously, Adobe Firefly is the main talking point, the AI tool that is used for video, audio, and design, and obviously used by Adobe, Google, OpenAI, Kling AI, and more. Try Firefly. It's a new generation, of course, of Adobe. So, as we can see, that's a very lovely creative work from various different companies, but obviously the main feature of the industry as it stands. So let's delve into it. Let's go without further ado, let's delve into the numbers, the figures, the fundamentals, and the bull versus bear case on Adobe. The market, as it says there, is pricing Adobe as if its a business model is broken. That's where I have my beef with Wall Street on this one. Let's go straight through to effectively the numbers which show that the business isn't broken as it stands, of course. Now, the future may well be different. I can't see it myself being that much different because of the numbers they've come out with. So historically, the forward PE was at 17.3. Free cash flow yield was historically at 4.7. So the valuation is compressed to historical lows. We'll come to the forward PE ratio, which is I think between 8 and 9 going forward. The disconnect, trading at a steep discount to peer group average. So as you can see, already was a discount compared to its other SaaS companies. Adobe is trading at 45% below its peer group average. So already you can see that there already has been it's the difference there between its rivals such as ServiceNow, Intuit, and CRM, although obviously do very different businesses, but it is part of obviously the SaaS apocalypse, which is double battered Adobe, I think, plus the fact that the Wall Street does not believe that it can eventually will compete against the AI revolution and also Canva and other editing tools. Now, in terms of opportunities, the industry's #1 in creative document and experience cloud. It has obviously various different apps such as, we know document and experience, high margins of 88 gross percent, strong cash flow of over $6 billion, wide economic moat, strictly ecosystem, switching costs and scale, which a lot of the people within the industry will not change to, well, not so far anyway. So the market fear is priced in. The fundamental says otherwise. So that's the start to what I see the overall picture in terms of the numbers. So the record financial raise for forward guidance for 26, also extremely strong. But let's take this apart for a minute here. Q2 FY earnings beat. So they beat on the last trading update by 13% year on year on revenue. Non-GAAP EPS 16% year on year up, beat estimates again. AR, that's the annual recurring revenue, which obviously is very important. That obviously tells us how many people are obviously joining in terms of the actual use of the software. $27.10 billion, 15% year on year record level again. Raised full year targets because business is so strong. Management actually raised its full year guidance to 26.5 to 26.6. Previously, they were actually looking at 26.2 to 26.3. So again, another average moved up there. Non-GAAP EPS 24.35 to 24.45. Previously at 23.95 to 24.05. Guidance raised, confidence backed by result. So obviously that is also another key point there, that, you know, we know that forward guidance on trading updates are very, very important. The numbers that they come up with, they tend to beat pretty much regularly. And I think you'll find out that 90% of companies, when they do trading updates, tend to beat their current numbers, but the forward guidance is where it comes down. So again, record results and a fantastic forward guidance for 2026. So before we go on to the DCF model and the share price, let's get through to the bull versus bear case, which I think is important because, as I said every time, it gives you a balance before investing in any company. And of course, I did a lot of research before I obviously bought more stock into Adobe. So, you know, we are looking at, for the bull case, which is probably my case really because of the fact that I've bought more, rock solid financials, high margins. The margins are phenomenal. Gross margin of 89%. This is gross margin is obviously the actual profit before all operations. But it is a humongous percentage of nearly 90%. Q2 was at 6.6 billion. TTM revenue at 25.2 billion, which is trailing, of course, and TTM EPS at 17. Consistent high margins throughout the business in terms of fundamentals. AI revenue scaling fast. Adobe's AI first annual recurring revenue is up, has tripled to $500 million. Yes, it could probably do slightly better. We know that, you know, people will never be happy, so to speak, but I think considering that the Firefly is now in its first few years, I think tripling its AIR is also very important. And I've got a feeling that this will move up. Aggressive capital return. Adobe announced a massive $25 billion buyback. Now, this is key, guys. A buyback, buying shares back off the market is key when your share price is at rock bottom, which is what it is with Adobe at the moment. And I think that's also a massive belief from management that Adobe is going in the right direction. So for me, that's a big plus when the management starts buying its own shares back. And also not just a small amount, 25 billion. 27 billion total remaining in buyback authorization. Management aggressively buying by its own shares, signaling they believe the stock is highly undervalued. So I think that's a big plus. Strategic acquisition, of course, mid-26, Adobe agreed to acquire Topaz Labs, AI image and video enhancement, which I would have thought will go well with, obviously, Firefly. And SEMrush recently closed its SEMrush acquisition, strengthening Adobe's digital marketing and analytics capabilities. So Adobe actively buying up other technology companies to improve its AI position. And finally, number 5 on the list, valuation dislocation, trading at roughly 8 to 11 times earnings, dropped from 17.9 forward earnings. Adobe trading at a historic low multiple, well below peers like Salesforce and SAP, of course, despite having higher gross margins. Recently upgraded to buy by HSBC, which also is good news for the stock. So possibly a very good time to, you know, in terms of those 5 points, in terms of bull side to buy. But let's go to the bear side just to give you a little bit of an alternative to obviously that. Now, I will bear in mind that, you know, what I've done, please don't copy what I've just done. You need to do your own due diligence on this, guys. I'm sure you'll have your own opinions anyway, but it's always worth mentioning that I'm here purely as advisory. So the bear case, guys, let's go through it. Slowing organic growth and decelerating ARR. Organic ARR growth has steadily decelerated, stripped away the SEMrush acquisition. Organic ARR has slowed towards the high single digits. Yeah, it's lost a little bit of momentum for sure. That could be a little bit of competition. It could also be to do with some of the AI stuff going out there, but I believe that will pick itself up for a reason, that the freemium, which is point number 3, I'll come to in a minute. Margin compression. Net margin for the last 12 months has slipped from 28.7 down from 30%, 30.4. Cost of running heavy AI workloads like Firefly marketing is starting to eat up in its profitability. But that's obviously, you can't win any other. If you don't spend the money to actually market the one tool that will be the future of the company pretty much, then you've got to accumulate to speculate as far as I'm concerned. So that would be my argument against that point at this moment in time. And it's only at the moment a fraction of a fall there from 30.4 to 28.7. Now, the freemium pivot risk. So the comeback cheaper AI narrative competitors like Canva, Adobe has pivoted towards a freemium model, Express and free Firefly tiers, deliberately sacrificing short-term AR a user funnel. So a sign of weakness, losing pricing power, relying on free tools to retain users. Yes, that is a plausibility that the more you put stuff on for free or cheaper, people will take advantage and it will be very hard to actually mark up that going forward. However, you could also look at it that way, that the more they can get people to use the software and use it in terms of going forward and using it regularly, that people eventually will pay the premium for it. That's, something that if you're a very good editor and you start using Firefly and you can't do without, eventually you will have to pay for the service. That's what it is. So I don't think that it's totally bad. Yes, I do get the point that maybe too much freemium could be a damage to the pricing power, but that time will tell. Now, the biggest probably gripe that I have going forward is the fact that we still have leadership uncertainty. We know that obviously the CEO has recently left the company, or not, is about to leave the company, and still no successor has been appointed. So there is definitely a vacuum going on there. Obviously, there's been a few other executives leaving as well. So Wall Street is probably right in this instance to be slightly anxious about where the long-term strategy for Adobe will go without a CEO of that experience that's been around for 20 years building Adobe to what they are now. Don't forget, Adobe was in the high of $700 to $800 a share, was the darling of the market for a long time. So no immediate successor is possibly the biggest issue for me in terms of the 5 points there. Now, coming to the last point, least but not last, AI commoditization threat. Agentic AI tools will eventually make complex software like Photoshop obsolete. Amateur creators can bypass Adobe's expensive ecosystem together. The core fear, Adobe's moat is eroding. AI threat. We've known about this for the last 3 years. We've been mentioning that, but there is no actual evidence as yet that the numbers are suffering from the AI agentic revolution and the fact that some of the software will be made redundant. So for me at this moment in time, Adobe will have a battle on its hand. There's no doubt about it that some of their software may well be competed against, but I still can't see it being replaced by many generations of editors and even people outside the editing side. I know my girlfriend uses the app to composite some of her stuff on Instagram, some of her work on Instagram, and feels that it's probably the best tool to be used at. So I think the fact that you can also, there is deals with various different other AI channels there, which are also now using Adobe, I can't see it being disappeared. I can't see it being that threatened. I think it will be within the fabric of the creative services, which will keep Adobe very strong going forward. That's my opinion. Of course, I may well be wrong in the next 5-10 years, but if you have to ask me whether Adobe will be around in 10 years, absolutely they will be. Now, in what capacity, I don't know yet. For the immediate future, I see they will be going from strength to strength as what they're doing specifically in what I've given you in the bull case. It's going to the DCF model and the actual share price itself. Now, as you will see, I have given it a very, very conservative growth rate, way below the low case of -1%. Now, this is assuming the worst. This is not assuming the worst, but this is assuming that the stock does struggle for growth within the next 10 forward years. On average, between 5 and 10 years, it's been between 10 and 9, call it 10 to 9% growth. And now we're giving it a very conservative -4% growth, depending on what's going to happen in the next few years. I believe that the growth will probably eventually go up to about 4 to 5%, which is the higher case there. But for now, let's argue for a conservative moment here. 4% with a discount rate of 8%, the usual 8% discount I give, with a perpetual rate, which obviously beyond the 10 years of 3%, which is based on GDP, US GDP average. The DCF model currently, or the reverse DCF model, which the markets tend to go at as it stands now, is at minus 9% growth. So you can see that there is still room for growth there in that respect. Now, that will give us, once you've obviously maxed out all these numbers together in terms of sums of free cash flow, cash and equivalent, total debt, equity value, and shares outstanding, we come to a grand total intrinsic price, the true worth price of the stock price, at $306 a share. Currently, at the moment, if I'm not wrong, is at 228. I think that's moved since last time we did this graphics. So it is obviously clearly massively undervalued. So what is the margin of safety? Now, guys, once we've given it a obviously intrinsic price of 306, we then minus the margin of safety as it's undervalued. Now, obviously, there is different criteria for different investors. Some people like to have a 50% discount, 40% discount, 30% discount. In my case, a minimum of 25%. That gives you a margin, or a buffering margin when you buy into a stock. In case the stock does fall further, it will give you already a margin of safety, as opposed to buying a company at a premium. So for me, 27% at the moment is bang in the ballpark in terms of buying more shares, and that's one of the reasons why I felt this was the right time to maybe buy in, as it was coming back from nearly 200. I think that obviously we know that the share prices have been affected by the departure of the CEO in the last trading update. The numbers were fantastic, but still it was bashed by investors. It is now on the way back up to a certain degree, and I still think 27.2%. I think it will fluctuate between 27 to 30%. So for me, that margin of safety is fantastic. Wall Street is forecasting a target price, not an intrinsic price, of 272, which is still an upside of 22%. So slight disparity there between what we think is the right price, or the target price. But for me, 306, I think, is a fairly reasonable intrinsic price. I think it could be higher than that, I think, based on the growth of Adobe. I think Adobe will easily grow within at least 4 to 5%, which obviously will give us a potential of $605 a share, which again would give us a massive upside of 126%. But I'm just being conservative for now because of the state of play. So, guys, my final thoughts on why I think Wall Street is wrong and why I've invested further in Adobe. Now, let's start with number one point here. Commercial identification. So, Firefly's trained on Adobe stock and public domain images. Adobe legally guarantees enterprise won't face copyright lawsuits. Canva and AI startups can't offer that. So I think that's a really good first point. Workflows, not just prompts. Professionals need more than just generating images. They need layers, vectors, typography. Editing is a absolute creative at the highest point, and I think people still need that software to generate AI inside the tools pros already use every day. So the pros will need more than ever Adobe, with the world moving into AI, and with Firefly they have that already in place. They are counteracting AI already, and they have been doing it for the last few years. It seems that Wall Street will not listen to this, in terms of the fact that Canva and some others will eventually catch up to Adobe. Now, that may well be the case, but at the moment, as it stands in the creative world, and even YouTubers or containers will still use Adobe as a form of software which is reliable, has the copyright lawsuits on its side as well, because obviously if you can use you can use some of the some material which could be completely legal, and you don't have any rights with Canva. But at the moment, as it stands, the commercial identification, the workflows are very much in the camp of Adobe. The freemium funnel, which I was actually in the bear case, I think in the strategic camp of the bull case from my point of view. Adobe's strategic freemium pivot has driven creative freemium monthly active users to 90 million people, 90 million users, sorry. Builders a massive pipeline of future paying professionals. I think that will eventually turn into monetization for the AI Firefly and will be used as an ultimate software going forward. Now, we've gone through the numbers. We know the numbers remain exceptionally strong at the moment. We know that there's been record revenue. AI revenue has tripled three times in year to year, over 500 million users now. AI first annual recurring ARR, world-class profitability, massive gross margin of still 89%. I will repeat, 89%. That goes on same par as some of the semiconductors margin for gross margin. So bear that in mind. The gross margin at 89% and net profit still at 28.7. I blight the fact that it has slightly dropped from 30%. Now, forward PE compression, which goes hand in hand with my DCF model. It just shows you how cheap the share price is currently at. Adobe has commanded a forward PE ratio of between 30 to 45 in the past, and even more recently 17. But because the stock has dropped down to almost between 200 and 220, the EPS has risen to 24.37 non-GAAP for fiscal 2026. Adobe's forward PE ratio has compressed to an astonishing 8 times earnings from that 30 times earnings. Forward. At 10 times forward earnings, Adobe trades cheaper than slow-growing legacy consumer staples, despite being a high-margin software. So the margins are high, and the compression is low. That is for any value investor, whether it's value investor for the long term or more medium term, is an absolute flag, a green flag to potentially buy into the stock. So as we can see there, the forward P ratio has come down to a historical movement. Even so, the margins are still high. The DCF model has proven, of course, that the share price is also super cheap at the moment by 27% discount, and probably a bit more depending on where the share price is at the moment, based on an 8 to 10% discount growth, and going forward for the next 10 years, I think we could almost say a minus, even if you're looking at a minus growth. Even, I'm going to repeat this, even so you're looking at a minus growth for the next 10 years, the intrinsic price is still at a fucking amazing price. And I think going forward, if they beat that growth rate, I think the share price will go up even more than 306. My ballpark would be maybe even, on a bit more of a positive note, even to $600 a share. These should go back to where it was initially. That will also depend on a lot of different circumstances going forward. Unfortunately, if I could see into the future, I would be a multi-millionaire, which I ain't. So there we go. So it is what it is. We have to go on current form and current situations of where the company is at the moment. It's an exceptional business with strong financials, attractive valuation. So it's a powerful combination for a long-term buy. So there we go, guys. This is where I stand with Adobe in terms of the business. I think it's a tremendous business. I have known it ever since I've been in the industry for the past 32 years. I'm not in it as much in it now, but I know it's the #1 tool used by creative professionals and also by amateurs on a fairly regular basis. I have seen it from other YouTubers that they use still Adobe as their main software. Yes, there is Canva nipping at the heels. Yes, there's other rival Figma as well that could actually catch up. But I think the moat currently of Adobe is super strong, and I'm not seeing any evidence that it is going to be lesser stronger for at least the next 2 to 5 years. But that's my opinion, that's my research. You guys might well differ with me, so please do make comments below whether you agree or not. It'd be great to, like I said, to get more comments from you guys when I upload these videos. So there we go, guys. This is where we are at with Adobe. That is my last opinion. So let's go and have a quick look at the share price and where I've bought it. So the chart for Adobe and where I bought. So I have bought a further £2,000 to £3,000 worth of shares. I haven't gone mad. I mean, I've gone for another 25% on top of already what I bought in. And I have bought in around 223. So a little bit earlier this week. So we're looking at, really just where we are now, where I'm showing here pretty much on the take. Now, as you can see, one of the reasons, of course, on top of everything else is the, it looks like fact the momentum which I abide to when I buy into stocks really is on the up, out of oversold after being in the doldrums for the past, well, especially on the back end of the last trading update, which, by the way, was fantastic, except for the fact that obviously we lost our leader of the company. But as you will see, the volume there as well has been pretty positive in terms of that. There was obviously this helps that HSBC has bought a buy rating, and that's kind of finally got the stock share price to potentially move. And the fact as well that there's other AI software that are now using Adobe or referring Adobe for graphics, which is quite interesting as well. So that's a fact to bear in mind as well. So as you can see, it's now back on the up. Like I said, I bought around that region here this last week. It's still well below its SMA 50 moving daily average of 50, and well below the 200. I think obviously if it went back above this here at 386, we could be looking at obviously going back to where it has belonged, which is above the 600 mark back in, well, as far down as January 24, before obviously there was a downturn through this AI apocalypse, or the SaaS apocalypse. We have to bear in mind that obviously Adobe's not just been attacked by Wall Street in terms of being attacked by Canva and Figma, and the fact that AI may well compete against some of the software of Adobe, but also the fact that in general every SaaS company, every software company has been attacked anyway in terms of performance. But Adobe is definitely one of the worst with, I think, CRM, Salesforce. I think they've been the most battered companies, and Intuit as well, for various different markets, but still part of the same gang. So again, this is why I think that the whole battering of Adobe has been wrong, in my opinion. Listen, I'm not a financial advisor. I've been doing it for 10 years, so I know what the markets tend to do and why they do it. And at the moment, it certainly has fallen out of favour for now anyway. But I'm seeing an uptick. Now, I think it could go up as far back up to maybe 300 to 350 for now. But that will obviously depend on news, whether or not, you know, the good feel factor, and whether Adobe can also find a replacement or leadership. But for now, I think this is probably a great time to buy back in, maybe even wait for it. If it does come back up down to maybe 200, maybe even better buy than where I bought at 223. But I'm in for the long term, because obviously I have bought in Adobe at a slightly higher price when it was at 10 to 15% discount. I got this is before I did my DCF model, and of course I got punished for really a falling knife, and so I'm holding the bag here in terms of debt at the moment on that stock. But I'm faithful that this is going to be a long-term strategy, and Adobe will hopefully be back to some kind of decent numbers. So there we go. There we go, guys. So like I said, please subscribe and like. Let me know what you think. This is just purely about Adobe. We're not going to have any news today. I will do that obviously for the next few days. But for me, this is where we are at with Adobe. So from one retail investor to another, this is Trader72. Subscribe and like. Comment below, please. And see you on the next one. Take care, guys.